Welcome to Celebrity Investing, your go-to source for insights, tips and updates on navigating the exciting landscape of personal and global finance. Please like, share and subscribe for more exclusive content. This is part 1 of Understanding the Cost of Capital, a guide for smart financial decisions. Every smart financial move starts with understanding the cost of capital. It's the foundation for deciding which investments make sense and which ones don't. Whether you're running a business or evaluating projects, knowing how much money actually costs to raise or borrow helps you make better choices. This concept isn't just for executives, it's crucial for anyone who wants to make informed financial decisions. What is cost of capital? The cost of capital is one of the most important financial concepts for businesses and investors. At its core, it measures what it costs a company to secure funds, whether through borrowing, selling equity, or reinvesting profits. For businesses, understanding the cost of capital helps in deciding whether a project is worth pursuing. For investors, it's a key factor in determining a company's potential value and risk. Definition and importance. The cost of capital refers to the return a company must generate to justify the expense of financing its operations. Think of it as the price tag for using money. If a project doesn't offer returns that exceed this cost, it's not worth the investment. For businesses, this acts as a benchmark. It helps determine if they should borrow, issue shares, or reinvest profits. For investors, the cost of capital helps gauge the company's ability to deliver returns that match their expectations. In both cases, it's a critical guide for smart decision-making. Why does it matter so much? Imagine you're running a business. If you don't know how much your money costs, how do you decide if a new product line is worth starting? Similarly, as an investor, you'd want to know if a company's returns can meet or exceed its financing costs before buying in. In simple terms, if the cost of bringing in capital is greater than the potential return, the numbers don't work. Components of cost of capital. The cost of capital has two main components that work together: the cost of debt and the cost of equity. Cost of debt. This is the cost of borrowing money, whether through bonds, loans, or other forms of credit. It's usually expressed as the interest rate a lender charges. However, businesses also account for the tax benefits of debt, since interest is tax deductible. For example, if a company pays a 5% interest rate and has a 30% tax rate, the after-tax cost of debt is effectively lower, at 3.5%. Cost of equity. This is the return investors demand for putting their money into the company. Unlike debt, there's no fixed interest rate here. Instead, equity cost depends on investor expectations, stock performance and risks. Shareholders expect a higher return since equity investments carry greater risk than debt. If a business fails, lenders get paid first, leaving shareholders with potential losses. Together, these form the weighted average cost of capital, WACC, which blends the cost of debt and equity based on how much of each the company uses. For example, if a company is funded 60% by equity and 40% by debt, WACC provides a combined rate that reflects the cost of both sources. In simple terms, the cost of debt is a bit like renting money, and the cost of equity is more like sharing ownership. Understanding both is key to grasping how businesses decide between financing options. Types of cost of capital. Understanding the types of cost of capital is essential for making sound financial choices. Each type carries its own implications and is calculated differently. Whether you're looking at equity or debt, knowing how these costs stack up can clarify your investment decisions and business strategies. Cost of equity, how it's calculated and why it matters. The cost of equity represents the return investors expect when they purchase shares in a company. Since equity holders take on more risk than lenders, they demand a higher return as compensation. There are a few methods to determine the cost of equity, but one of the most widely used is the Capital Asset Pricing Model, CAPM. The CAPM formula is cost of equity equal risk-free rate plus beta x, market return risk-free rate. The risk-free rate is the return on risk-free investments, like government bonds. Beta measures how much a stock's performance swings compared to the broader market. A beta greater than 1 means more volatility, while less than 1 suggests less. The market return minus the risk-free rate is called the market premium, representing the additional return investors expect for taking on market risk. For businesses, the cost of equity is important because it sets a benchmark for evaluating projects. If a project cannot generate returns exceeding this cost, it is unlikely to satisfy shareholders. For investors, it signals the level of risk they are taking on. Higher costs mean higher risks, but also the potential for greater rewards. Cost of debt, what it is and its role in financing decisions. The cost of debt is the effective interest rate a company pays on its borrowings, such as loans or bonds. It's calculated as the interest rate on the debt, adjusted for the tax advantage companies enjoy since interest payments are tax deductible. Here's the formula. Cost of debt equals interest rate x, 1 tax rate. For example, if a company secures a loan at 6% interest and has a tax rate of 30%, the after-tax cost of debt would be 6% x, 1.3, x 4.2%. Why does this matter? Debt is often seen as a cheaper way to raise funds compared to equity. Lenders prioritize repayment over shareholders in case of liquidation, meaning less risk for them, which translates to lower costs. However, businesses must be careful not to take on too much debt, as excessive interest payments can hurt cash flow and increase financial risk. In short, the cost of debt reflects the price a company pays to rent money. Used wisely, it can be a powerful tool, but over-reliance can lead to financial strain. Weighted average cost of capital, WACC, the big picture. WACC brings together the cost of equity and the cost of debt to give a single blended rate. It reflects the overall cost of raising funds, weighted by the proportion of debt and equity in a company's capital structure. The formula for WACC is WACC EVX RE plus DVX X 1 the TC, where at market value of equity, D is market value of debt, V total value of capital ED, real cost of equity, AD il cost of debt, TC il corporate tax rate. For example, if a company is 70% funded by equity at a 10% cost and 30% by debt at a 4% cost after taxes, the WACC would be WACC equal 0.7 per 10% plus 0.3 of 4%, il 7.8%. WACC is a critical figure for businesses. It acts as a hurdle rate, meaning a project's expected return must exceed this number to create value. For investors, WACC provides insight into how efficiently a company balances its funding sources. Why does it matter? Think of WACC as a weighted scoreboard. It tells you the overall price tag of a company's capital. A lower WACC means cheaper access to funds, which can make a company more competitive. Factors influencing cost of capital. Understanding the factors that influence the cost of capital can shed light on why it's higher for some companies and lower for others. Each business operates in unique circumstances, and these conditions directly affect the cost of raising money. Below, we'll break down 3 key factors that play a major role. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.